This is John Polemy of the Actionable Intelligence Alert. Today is April 7th, 2018. Today's video, I want to talk about something that I use that's a very powerful tool that's really juiced my returns. And what I found is I've written articles about this on my blog or website, and they get very little attention. But yet, they're this idea is responsible for some of the best returns I've had over the last 3 to 5 years. So I wanted to get into this a little bit today and discuss the CAPE ratio and how I use it and why it works. And hopefully this will persuade some of you guys to think about incorporating it into your uh, investing and speculating repertoire. So basically, CAPE ratio, how to use it for market beating returns. So first of all, what is the CAPE ratio? Well, it stands for the cyclically adjusted PE ratio. And this is just a definition from Investopedia. I'll read it. CAPE ratio is a valuation measure that uses real earnings per share over a 10-year period to smooth out fluctuations in corporate profits that occur over different periods of a business cycle. The ratio is generally applied to broad equity indices to assess whether the market is undervalued or overvalued. While the CAPE ratio is a popular and widely followed measure, several leading industry practitioners have called into question its utility as a predictor of future stock market returns. So I want to touch on that. That's the definition. Basically, um, Professor Schiller, Robert Schiller, did a lot of work on this. There are white papers. He actually has a website, I believe, that gives a lot of information about it. But most of my information on the CAPE ratio came from a guy named Meb Faber, who I've talked about many times on podcasts. Very smart guy that runs some funds in California and does a lot of research. Basically puts all of his research up for free. And the book that he's written a couple books and several white papers, but one was specific to the CAPE ratio, really persuaded me. So I just want to kind of talk about that last sentence first before we go on. Leading industry practitioners have called into question its utility as a predictor of future stock market returns. And I'll talk about that right now. I mean, right now, if you look at the CAPE ratio for the United States stock market or for the S&P, it's at historic highs. It's like the second or third overvalued things have ever been based on CAPE. Now, it's been like that for several years. So the argument has been, I've heard several market analysts or other newsletter writers uh, say that, well, if you would have followed this methodology, you would have sold the U.S. stock market a couple years ago and you would have missed out on this big gain. That's true. That's absolutely true. But we don't just apply this CAPE ratio, or I don't, in my toolbox as a way to just use it for predicting the US stock market. It applies to all the stock markets around the world and to industry groups. So, yes, in fact, uh, you probably would have missed out on this big gain we've had over the last year or so. But you would have been invested if you looked at deep dove this, that oil and gas, mining, and metals, some of these things were very, very undervalued on CAPE, and you would have been able to at least known that you could have had the potential to rotate into metals and mining, which have done exceptionally well over the last year. So one of the things you have to keep in mind when you're talking about this CAPE ratio is you have to think in long periods of time. It's not a market timing tool. It's not used to say, okay, well, it hit 30, I automatically sell. It's a methodology to give you a 30 or 40,000 foot view to say this place is overvalued or this place is undervalued, and that kind of cues you up to do additional research to see if there's any other catalysts, like in an undervalued situation, if there's any other catalysts that would pique your interest to make you think, okay, this thing is undervalued and it's ready to turn and do some mean reversion. So what CAPE is not, it's not a market timing tool. I mean, there's no set thing to say, well, when you get into an overvaluation of like a CAPE of 20 or 30, immediately just sell. That doesn't That's not how it works. We know based on CAPE historically, relatively to other market times or history, that the market's overvalued. That means you should just be cautious. The market can go substantially higher. Actually, I've said this before. I think the market is going to go higher. I think it's going to be a final blow off top that sucks every last dumb dollar, every shoe clerk, every barber, every school teacher's money into this thing. So just because something's overvalued doesn't mean you can't get more overvalued. But if you're prudent and you understand this tool, you could say, well, I need to tighten up my stops, or I need to pay more attention to my allocation. I don't need to be buying the FANG stocks, I need to be looking more towards value if I'm going to stay in a particular overvalued market. So that's how the tool is actually supposed to be used. It's just one tool in an overall toolbox. I mean, you can't build a house with just a hammer. You need a saw, you need a drill, you need other tools. You can't just build an entire house just with a hammer. So you just can't use one market tool or timing tool or valuation tool to um, allocate capital. So, like I just said, this is overvalued markets can get more overvalued, and undervalued markets can get more undervalued. So here's a quote from Meb Faber from this paper that he wrote. It's called Global Value, Building Trading Models with the 10-Year CAPE, and I put a link to it right there. You can go read that white paper. I suggest you do it. It will really, it's only about 8 or 9 pages. It will explain very easily how this works. But Meb says, however, valuation is best used as a strategic guide rather than as a short-term timing tool. It is most useful on a time scale of years and decades rather than weeks and months or even days. And that's just exactly what I said. And that's a differentiation that you need to make. And when you hear these analysts poo-pooing the CAPE, you know, these are people that are, want the market to go up, and they're fully invested in the bullish argument. So when you throw the CAPE at, they're like, well, it doesn't work. It's not a market timing tool. Or, well, the market's still overvalued. And we've seen that with some of these stocks starting to crack, like Tesla. And, you get the breadth of the market as it goes higher gets tighter and tighter. Less stocks are participating in the moves higher in these overvalued markets. Here's what I think that kind of last comment kind of segues into this slide. The real reason CAPE doesn't work, and I put that in quotations, people are impatient. They don't have an investment horizon spanning years or decades. When I'm talking about investing, I'm talking about for long periods of time. If we're just going to be playing a turnaround in certain market sectors or holding something for 3 to 6 months because we think it's going to pop, that's speculating. If we're going to invest for the long term, we need to look for value, and that's what the CAPE ratio helps us do. It helps us determine what is relatively undervalued, not only to the rest of the markets but to itself historically. Because I'm a big proponent of mean reversion. I mean, that's one of the key things that I use to determine where to place capital. So another reason why CAPE doesn't work for a lot of people is because they like action. They're seeking something besides market beating returns. I mean, we went over this before, guys. I wrote a whole article about why people stink at investing. They're not really investing or speculating, they're gambling. Okay? And there's plenty of literature out there about, gambling and what happens in your brain. It's the same thing, like people are constantly checking Facebook or Instagram. They're constantly seeing how many people likes they have, or you know what you're getting here is you're getting a response inside your brain, a chemical response like a dopamine release, so that when you're trading stocks, or you're sitting at a crap table, or you're playing blackjack, or you're checking your Instagram likes, you're getting a dopamine release. It's stimulating the pleasure centers of your brain. And that's what people are doing when they're trading all the time. And that's why CAPE doesn't work, because CAPE is boring. But that's why Warren Buffett's a billionaire, and most of the people listening to this thing don't have two cents to rub together. That's the difference. Arbitraging time, arbitraging patience. Okay? Very difficult to learn, easy to understand. I can sit here and explain it to your logical side of your brain, and you say, yes, that makes sense. You can go read Warren Buffett's Berkshire Hathaway annual reports. They put in there the average return over the last 25, 30 years. Same thing with Prem Watsa at Fairfax Financial. And you'll see these guys consistently were beating the market over their careers. That's because they put money into undervalued securities and just sat there and wait for them to become less undervalued. That's it. But that's boring. You're not going to get a dopamine release doing that. Like, shooting the dice every 30 seconds or checking your Instagram likes. I mean, guys, this is really what it's about, psychology. This is what one of the main differences is between people that make money in these markets and people that don't make money. It's very difficult to understand, or not difficult to understand, excuse me, but very hard to implement. So just like I said, people are gamblers and they crave the dopamine release they get from trading, and it makes it so easy. Wall Street's made it very easy. You can do it from your phone now for very little commission or no commission if you have Robinhood. You can just say, well, I'm going to get the stock, and as it goes up, 10 or 20% in the next month, this stimulates the pleasure centers of your brain. You get a dopamine release. Just like if you get 20, you put some, quip on Twitter and 20 people like it, well, you start thinking, I mean, it's just how it is. It's just how the human psychology works. It's hard to sit and be bored, but it's the most, I shouldn't say popular strategy, but it's the best strategy for making money long term. You know, be right and sit tight. I mean, that's Jesse Livermore said that. He made most of his money by just sitting there and letting these things mean revert. But that, like I said, that's boring. You sit there, twiddle your thumbs. When you have your phone, you're checking, you got your stocks on Yahoo Finance, or you're checking it every 5 minutes. It's boring to just sit there and wait for these things to turn around. So here's a chart of the U.S. stock market averages real compound returns versus 10-year CAPE from 1881 to 2011. This was in Mev Faber's white paper. And what you see here along the left side on the column are basically the CAPE ratio numbers. So less than 5, 5 to 10, 10 to 15. You can read this yourself. And here's what you can see, guys. You can see this is basically the time spent in this percentage here is the time spent in those particular areas. But here, look at the returns. Basically, the cheaper you buy markets or industries, the higher the return over time. The more expensive the market is, and you put money in expensive markets, and we're here, the U.S. is down here right now, 30 to 40. Look at your 1 year, 3 year, 5 year, 10-year forward real compound annual growth rates. You have negative returns over 10 years, guys, and I can guarantee you during that time you're going to have a big drawdown. And you can say to yourself, well, John, you just said that the PE rate, the CAPE in the U.S. is over 30 right now, or around 30. So you're telling me that over the next 10 years, my compound annual returns are going to be minus 0.3%? Well, right now the market's up over the last year. Well, that's true, but guys, we're probably going to have a drawdown of 30, 40, 50% in the next few years. See, that's what people don't think about. And if you go buy cheap, you usually don't have these big drawdowns. The thing is so cheap, you're going to revert to the mean. Like I said before, I've talked about this before. I talk about the country, like I'll give you an example, Cyprus from a few years ago. Cyprus had its banking crisis. They had the bail-in. It was all over the news. If you had over $100,000 in your bank account, they seized it to recapitalize the banks. Oh, it's terrible. It was terrible if you had over 100,000 euros and you got your money seized. And the whole banking system was nutted up. The economy basically contracted severely. There was very high unemployment, a lot of foreclosures, a lot of problems. But guess what? The island of Cyprus did not dry up and blow away. The island of Cyprus is a very big tourist attraction for Northern Europeans and people from Europe. Okay, so when you have an economic crisis like that, and people are not going to stop coming there, okay? And the banking system was forced to consolidate. They got recapitalized by the European Central Bank. A lot of these banks, marginal banks, went away or were forced to merge. Now there's only like 2 or 3 big banks there. And Bank of Cyprus, for example, is one of the banks that was a survivor. It brought in professional management from another bank in Ireland. The management helped turn that bank around. So they came into the Bank of Cyprus. Oh, and lo and behold, what happened? Over several years, the economy reverted to the mean. Okay? The policies put in place, basically healed the economy over time. Okay, so you could have went to Cyprus during the peak of the economic crisis, and the stock market was down 99%. 99%. If a stock market around the world is down 99%, I think you have to take a look at it. You could, and what the funny thing was, there were actually companies that were selling on that stock exchange that were actually still profitable because they were exporters or they were based on tourism. And some of them were actually still paying dividends through the entire crisis. And you could have picked these things up for a penny. Literally, you could have bought $1 for a penny or 2 pennies. That is how real wealth is created. So if you bought some of these stocks, which I did, some of them are up several 100%, guys, within a year or 18 months. And Cyprus now is one of the fastest growing economies in Europe now. Last year it grew 3.8%. So you got an old, staid economy almost growing 4%. Non-performing loans at banks are going down. The banks are healing. Tourism is making record highs. Huge natural gas finds being found on the south side of Cyprus. So that's what I'm talking about. That's an example of how you use this CAPE ratio. Now let me give you a more recent example. I have this in the free portfolio that I put up, and it's Egypt. So Egypt went through, the Arab Spring back in 2011. The Muslim Brotherhood took over. There was all kinds of nonsense going on, and the economy was really affected. It was off the rails. Then about 2 years ago, a jetliner with Russian tourists was shot down over the Sinai. So tourism collapsed by about 80%. So finally, enough was enough, and the Egyptian military stepped in. Kicked out the Muslim Brotherhood and installed this new guy, Sisi or Sisi, however you say it in there. And he immediately, he's a secular guy, cracked down on the Muslim Brotherhood, and they started implementing economic reforms. They did a big devaluation of the Egyptian pound. You can see that right here. This is when it happened on the big drop in the Egyptian. This is the Egyptian stock market ETF. Here's the big drop from the devaluation. Well, I like to see that because, that coupled with reforms, same thing. Egypt is not going to drop and blow away. So the risk reward is slanted higher. When you devalue the currency, you make exports less expensive, and you also makes it cheaper for tourists to come there. Yes, it's not good for the local population because imported goods cost more and inflation starts taking off. But that's the point of the economic reforms, is to clamp down on all that and to get that under control. So again, that CAPE ratio on that was very, very low. I mean, it was less than 5. So you have to buy something like that. And lo and behold, economic reform started kicking in. The IMF came in, they recapitalized the country, the devaluation of the pound kicked in, and what did they do? They found huge natural gas reserves also. So that's helping them to, on their balance of payments, because they're not having to import natural gas. They're probably going to become an exporter here in the next couple of years. And you can see what's happened to the Egyptian market. It's basically, in probably 18 months, recovered back to where it was. Now I bought it back down here. We were buying it back in here, guys. And you just have to sit and wait for the mean reversion. Now it's overvalued now. It's been up quite a bit, but the stock market in Egypt is up over 40%. And I think if if this thing pulls back and you buy it, you're going to do well over the ensuing years. And that's what real investing is about. I don't know anybody that's going to spit in the face of a 40% return in 18 months. That's pretty darn good. And guys, this is happening over and over and over. Now you don't just buy one of these, you buy a basket of these things. You buy, 4, 5, 6 of these things. There's always 4, 5, 6, there's always, there's people that publish the CAPE ratios on a quarterly basis. So all you need to do is buy the half dozen cheapest markets, sit back, and then rebalance every quarter or every 6 months or every year. And I think that based on Meb Faber's white paper, if you read it, you'll see that your returns are going to be market beating. You have to do very little work. But this is one of the least read articles on my website. This is one of the easiest ways to make money, which is to just buy stuff that's cheap and wait for it to mean revert. You don't have to do any research, you don't have to do too much research. You don't have to, fret. I mean, these places are not going to go away. you look at the relative valuation over the history of the market of Egypt, you see that you're way under that relative, you're way undervalued on a relative basis. You just buy and wait. Here's what happens. So here's some current opportunities just based on the recent CAPE ratios. You know, the first row here, you're looking at Greece, Russia, Poland, and Spain. Forgot to put Portugal in there. It's pretty cheap too. But, look at Greece, guys. It's actually got a negative CAPE. I mean, you got a negative. So what you do is you just go and buy the ETFs of these 5, 6 countries, and you just sit there and wait. I mean, that's the easiest thing to do. If you want to do some more fundamental analysis of are they turning around? I mean, Greece is an excellent story. People don't understand that the Chinese have moved in there, tremendous Chinese presence there. They've bought up ports. They consider Greece, the Chinese consider Greece a strategic place for them to enter the European market as part of their One Belt, One Road. They actually call Greece the head of the dragon. And they've bought up all kinds of ports there. They're doing all kind of infrastructure upgrades. There's direct flights now between Beijing and Athens. Tremendous amount of visitors and tourists from China. So the place is just cheap. It's the same thing that you're seeing in Cyprus. It's about 2 years behind on the banking system. The banking system had to consolidate after the collapse. Um, Remember all of the riots in the streets, all the things on the news. Greece is going to drive and blow away. It's got more debt than any place in the world. It's still there. Okay, the Chinese aren't putting money in there because it's going to drive and blow away, guys. It's a cheap place. So what you do is you just buy the ETF. If you want to get more aggressive, you just go put an equal amount in the 3 top banks there and just wait 10 years. You're going to make a tremendous amount of money. So I mean, you can go down further if you want to get into emerging markets. Cyprus, we've already talked about that. Ukraine, I've talked about that off and on. I mean, you can buy agricultural companies there for, I've got one company that I've recommended, Agroton, that I've talked about in previous newsletters. It sells for a PE of about 1, and the stock's up about 200% since I bought it. Colombia is another place that has tremendous opportunity. It has an ETF you can buy, or you can just buy one of the big banks down there. And here's another one. I mean, that here you got Nigeria. It's down. The stock market there's down over 50% over the last few years. Yet the yield is over 3%. Okay, you get the yield of 3% on the stock holdings in Nigeria, and the market PE is less than 6. Okay, you just buy the ETF. There's an ETF out there, guys. It's called NGE. You just buy it and wait for mean reversion. You know, oil production is actually up in the country in the last few years, and the political situation there has subsided quite a bit, and now you have a reemergence of oil prices going up. That's going to help the country. It's a major oil producer and exporter. I mean, this isn't really too hard. I mean, maybe I'm just overthinking this, but to my mind, it's not that hard, guys. And yet, like I said before, this is one of the least visited or read areas of my website. And to my mind, this is the easiest way to make money. It's set and forget. Every 3 months you rebalance. So that's the CAPE ratio, guys. That's how I use it. I will link to the article on my website. You can read some more about it. I did some work in there, some more work on, and some more links to places like where you can that publish the CAPE ratios and update them regularly. So all this information is free. So I really suggest you take a look at this. I think that you will find that it will really help your returns if you want to be an investor. If you just want to speculate and gamble, I get it. That's what people like to do. But if you're really interested in long-term returns, here's an excellent tool that you can use to identify prospective markets and even industries. I mean, they even break this down for industries in the U.S. And some of the cheapest industries right now in CAPE are oil and gas and metals and mining. So, like I said, this isn't too hard. It's just that people won't use it because of some other things going on, I think. So take a look at it, and appreciate you guys listening. If you continue to value what I'm putting out here, I ask that you like the videos and subscribe and share them with your friends. We'll talk to you next week. Thank you.